Have you ever wondered how pro traders make money when the market's just flat? Well, we are about to pull back the curtain. We're diving into a key chapter from Colin Bennett's Trading Volatility to see how they move beyond simple bets and learn the art of trading relationships. It's a great question, right? Because we're all taught to think about stocks going either up or down. But what about when they're just moving sideways? You see, that's where some of the most sophisticated strategies come out to play. It forces a total shift in focus, away from where the market is going to how all its individual pieces are moving in relation to each other. All right, here's our game plan. We're going to start with the big idea, trading relationships. Then we'll get into the nuts and bolts of relative value and correlation. After that, we'll see how these ideas are used to trade those massive market jumps and check out the toolkit the pros use to get it all done. Okay, so this is the crucial point. This is the big pivot. Advanced traders often stop betting on which way the market is headed, and they start betting on relationships. It's a complete change from the kind of trading most of us know, and it's absolutely essential for finding opportunities in any market condition. This is a huge mental shift. Seriously, you stop looking at a single stock and its direction. Instead, your focus is on the connection between two assets. The questions completely change. Now you're asking, do these two things normally move together? Has that connection somehow broken down? And, most importantly, is there a profit to be made when things snap back to normal? So how does this actually work in the real world? Well, it all starts with a core concept called relative value. You could say it's the bedrock of all non-directional trading. Okay. In simple terms, here's what you do. You find two things that usually move together. Think of, say, two big oil companies whose stocks are almost always in lockstep. Then, for whatever reason, one stock shoots up and the other one doesn't. That gap between their prices gets weirdly wide. A relative value trader bets on that gap shrinking back to its normal historical average. See? They're not betting on the price of oil, they're betting on the relationship. And this slide just lays it out perfectly. On the left, a simple bet on one stock's direction. But on the right, it's a much more sophisticated bet on the relationship between two stocks. And here's the amazing part. With relative value, you could actually make money even if both stocks go down, as long as that price gap closes just like you predicted. Okay, now let's take it up a notch. What if you applied that same logic, but not to price? What if you applied it to volatility? The choppiness of a stock. Traders can literally bet that one stock has gotten unusually choppy compared to another, and that relationship will eventually get back to normal. This just opens up a whole new dimension for trading. So we've gone from looking at one stock to looking at a pair of stocks. Now let's zoom out even further and look at the big picture, the relationship between all the stocks in an entire market. Welcome to the art of correlation. Think of it like a group of dancers. In a high correlation market, all the stocks are doing the exact same moves, perfectly in sync, like a professional dance crew. But in a low correlation market, well, everyone's dancing to their own beat. It's more like a mosh pit. Understanding that dynamic is everything. And this is where the magic of correlation really happens. Check this out. You can have two really choppy, volatile stocks, but if they aren't moving in perfect lockstep, their individual ups and downs can actually cancel each other out. The result? A much smoother, less volatile index. This is the whole principle behind diversification, right here. And here's the crucial part. Correlation isn't just a concept. It's something you can actually trade. The book goes into a whole toolkit of these complex instruments that pros use to bet on whether the market is going to become more like that dance crew or more like that mosh pit. These are the tools that turn a broad market observation into a very specific trade. Now that we get how stocks move together as a group, let's zoom way in on one of the most dramatic moments for an individual stock, trading those sudden, massive price moves. We're talking about jumps. This is where volatility trading gets really interesting. Yeah, these are the moments that can define a stock's entire year. An earnings report drops and bam, in the blink of an eye, the stock gaps up or down by 10, 20, maybe even 30%. These are the jumps. And for traders, they represent massive opportunity and, of course, massive risk. So how on earth do you trade something so explosive? Well, traders use options to figure out the exact size of the jump the market is expecting. They can actually put a number on the market's collective guess, and then they can bet against it. They can bet that the actual jump is going to be either way bigger or way smaller. What's so fascinating here is how they mathematically strip out all the normal, day-to-day volatility. That's the background noise, to place a pure bet on that one explosive moment, the jump itself. It's kind of like a sound engineer isolating a single drum beat from an entire orchestra. But of course, in the real world, it's never that simple. This chart shows that a stock's implied volatility, that red line, is being pulled on by two things: the upcoming earnings report and the overall market trend, which is that gray line. So to really isolate the jump, you have to strip out all that market noise to understand the bigger picture. So with all these different strategies, how do you pick the right tool for the job? From trading simple pairs to these complex jumps, it's all about understanding the trade-offs. Let's break down the options. Yeah, the book makes it very clear. There is no one-size-fits-all solution. As you can see, every method has its pros and cons. Trading the stocks directly, it's simple, but you're exposed to a lot of risk. Using options can protect you, but man, they can get complex. And these specialized outperformance options give you a pure bet, but they can be harder to trade. It really just comes down to an investor's own risk tolerance and level of sophistication. And really, that's the ultimate takeaway. This kind of advanced trading is a total paradigm shift. It's about moving beyond just trying to predict the future and instead learning how to profit from the hidden relationships that drive the whole market. It kind of forces us to ask a really powerful question. Are we just watching the dancers, or are we paying attention to the dance itself?